two friends, Alex and Sam, invest the same $6,000 every year for 30 years into the exact same investments. Yet, at retirement, one walks away with tens of thousands more, simply because of the type of account they chose. That's the power of tax-deferred versus tax-free accounts. In the next 8 minutes, I'll explain both, simply. Let's dive in. Here's what most beginners overlook. It's not about how much you earn. It's about how much you actually keep. Taxes quietly eat into your returns every year. That's why the government created special accounts with built-in tax advantages. Two major types. Type 1. Tax-deferred accounts. Deferred simply means postponed. You contribute money before taxes are taken out of your paycheck. Those contributions reduce your taxable income today, which means a smaller tax bill right now. And your money grows untaxed year after year, but here's the catch. The taxman hasn't disappeared. He's just waiting. Every dollar you withdraw in retirement is taxed as ordinary income. The most common tax-deferred accounts, the traditional 401(n)(a) through your employer, and the traditional IRA, which you can open on your own. Many employers even match part of your 401(n) contributions. That's literally free money added on top of your own. There's also the 403(b) for teachers and nonprofits, and the 457 for government employees. Contribution limits rise most years. Check current IRS numbers. Let's see the math. You earn $60,000 and contribute $6,000 to a traditional 401(n). Now you're only taxed on $54,000 this year, while that $6,000 goes straight to work in the market. It compounds for decades, completely untaxed as it grows. Money that would have gone to taxes keeps generating returns for you instead. So when does the tax bill arrive? When you withdraw in retirement, typically after age 59 and a half. Withdraw earlier than that, and you'll usually face a 10% penalty on top of the regular income taxes. And one more rule, required minimum distributions. In your 70s, the government forces you to start withdrawing every year, whether you need it or not. Now let's flip the script. Tax-free accounts. Here you contribute money you've already paid taxes on. No tax break today. But from that moment forward, the magic begins. Your investments grow completely tax-free for decades. And when you withdraw in retirement, you pay absolutely nothing. Every single dollar in that account is 100% yours. The superstar here is the Roth IRA. There's also the Roth 401(n), employer convenience with tax-free growth. And don't overlook the health savings account, the HSA, often called the most powerful account in America. It's triple tax advantaged. Contributions are deductible. Growth is tax-free, and withdrawals for qualified medical expenses are tax-free too. One caveat: Roth IRAs have income limits, so high earners may need alternative strategies to get money in. Let's run the numbers. Invest $6,000 a year into a Roth IRA for 30 years. Depending on market returns, that could grow to well over $500,000 sitting in your account. In a tax-deferred account, every withdrawal gets taxed. In your Roth, you keep every single penny completely tax-free. Time for a side-by-side, tax-deferred, tax break now, taxed later, and mandatory withdrawals in your 70s. Tax-free, no break today, zero taxes later. And with a Roth IRA, no required minimum distributions during your lifetime. Think of it like this. Tax-deferred is a discount at the entrance, but you pay at the exit. Tax-free means paying full price at the door, and then everything inside is free, forever. So which should you choose? It comes down to one question. Will your tax rate be higher now or in retirement? In your peak earning years and a high bracket today, tax-deferred accounts give you valuable savings right now. Early in your career, expecting to earn more later. Pay taxes today at your lower rate and go tax-free. But here's what many financial planners actually recommend. Don't choose it all. Diversify your tax exposure, just like your investments. Step 1. Contribute enough to your 401(n) to capture the full employer match. Never leave that on the table. Step 2. Fund a Roth IRA. Step 3. If you still have room, go back and max out that 401(n). Owning both buckets gives you flexibility in retirement. You control which account you withdraw from and manage your tax bill strategically. Before we wrap up, let's cover 4 common mistakes that quietly cost investors thousands. Mistake 1, ignoring the employer match. That's a guaranteed 100% return you're refusing. Mistake 2, withdrawing early and getting hit with penalties plus taxes at the same time. Mistake 3, forgetting the 5-year rule. A Roth IRA generally must be open 5 years before earnings come out tax-free. Mistake 4, parking cash in these accounts without investing it. An account is just a container. You must invest inside it. Avoid those 4 traps, and you're already ahead of most investors out there. Let's recap. Tax-deferred accounts, like the traditional 401 and IRA, save you taxes today, but tax you in retirement. Tax-free accounts, like the Roth IRA and HSA, tax you today, but never again. The best strategy for most people? Use both. Start as early as possible, and let compounding do the heavy lifting. Because remember Alex and Sam? The difference wasn't luck or income. It was simply understanding how their accounts were taxed. If this made taxes a little less confusing, hit like. Subscribe for more simple money breakdowns, and I'll see you in the next one.